Imagine waking up Monday morning, you check the markets, and boom.
Yeah.
The major chipmaker stock has just cratered. That's exactly what happened today, Monday, August 4th, 2025, with Semiconductor.
Yeah.
You might know them as Onsemi. Their shares plunged. I mean, really plunged 13% this afternoon.
Yeah, it made them the worst performing stock in the whole S&P 500 for the day.
Exactly. It's this massive nosedive that just makes you stop and ask, okay, what on earth is going on here? So let's try and unpack this. This isn't just some random blip, right? This is a big deal for a company that's, powering so much stuff, EVs, industrial tech. And for you listening, figuring out why this happened, well, it's a great shortcut to understanding the bigger forces shaking up tech and finance right now.
That's exactly right. Our mission here today is really to untangle this whole web. Why did Onsemi stock drop so dramatically? We're going to look at the CEO's warnings, pretty stark warnings, actually their latest financials, what's happening in the wider market, and, where Onsemi fits strategically. The goal is to pull out the key insights so you understand not just the what, but the why. Why this matters for the economy, for tech's future.
Okay, so to really get into it, we have to start with that moment, that immediate kind of gut-punching drop on Monday. What did that 13% fall actually look like on the ticker?
Well, the stock ended up closing at $47.97.
Okay.
But that reflects an intraday fall of 15.58%. That's a really sharp reaction. Shows a lot of investor concern, clearly. And to put it in perspective, with this drop, Onsemi shares are now down over a fifth, 22.22% actually, just since the start of 2025.
Wow, year to date.
Yeah, and over the last 12 months, down 27.83%.
Ouch.
Now, contrast that with the S&P 500 index. It's actually up 7.43% year to date.
Right, so Onsemi is really swimming against the current here.
Definitely fighting a strong tide.
You mentioned a CEO warning kind of kicked this off. What exactly did Hassane El-Khoury, the CEO, say that hit the stock so hard so fast?
Well, he didn't really pull any punches. He pointed straight at cautious customer behavior and, slumping sales.
Cautious behavior.
Yeah, and he got specific. He said, quote, both Europe and North America are weak. And he also mentioned he believes there's a lot of uncertainty in the automotive market.
The automotive market, yeah. That's a big one for them.
It is. And this isn't just, typical CEO cautious talk. It signals a real shift. Customers aren't ordering like they used to. He even added that customers are waiting to the last minute to place an order.
Ah, so uncertainty leading to delays.
Exactly. It indicates a real slowdown, a lack of urgency, and that hits their revenue predictability hard.
That does sound pretty stark. But, how much is just managing expectations in a tricky market versus what the actual numbers show? Did their Q2 results back up his worries?
They absolutely did. Although, it's interesting, their reported revenue, $1.47 billion. Okay.
That was actually down 15% year over year, 15.36% to be exact.
Still a big drop.
A big drop, yeah. But it did slightly beat the analyst consensus estimate by about 3.1%. And their adjusted earnings per share, 53 cents, that matched expectations.
So top line wasn't a total disaster compared to estimates?
Right, but that's not the whole picture. What's really fascinating and frankly quite concerning is what happened with their profit margins.
Ah, the margins. Okay, tell us about this. Because beating revenue slightly doesn't help if you're not making money on it.
Precisely. The adjusted gross margin, it plummeted, down 770 basis points.
770, wow. What does that translate to?
It means their gross margin fell to 37.6%. So that's a 7.7 percentage point drop. Huge.
Okay, that's significant. And operating margin.
Even worse, adjusted operating margin dropped an astounding 1,020 basis points.
Over 1,000 basis points.
Yeah, down to 17.3%. This massive margin compression, it just screams intense pricing pressure across all their main segments: power solutions, analog, intelligent sensing. So it's not just fewer sales, it's making significantly less profit on each sale they do make.
That's the brutal truth. That 1,020 basis point drop. It's like falling off a profitability cliff. They're having to fight really hard for every dollar.
Those margin numbers are really something. It hammers home that profitability squeeze. And you mentioned automotive earlier as a key concern, and it's what, over half their business?
Yep, 52% of total revenue in 2023.
So is that segment where the pain is sharpest?
It absolutely is. Automotive revenue fell 4% just quarter over quarter, down to $733 million in Q2. And if you look back at the year-over-year declines in 2024 for specific auto parts, their power solutions group, that's chips for power management in cars, that fell 16% year over year.
16%.
Yeah. Analog and mixed signal dropped 14%. Intelligent sensing, think cameras for driver assist, down 15%.
So broad declines within automotive. What's driving that specifically? You mentioned uncertainty.
Yeah, it really comes down to macroeconomic factors mostly. You've got stubborn inflation, high interest rates putting a damper on EV adoption.
Makes sense. Cars are expensive purchases.
Right. And automakers themselves are delaying production, cutting costs. Plus, things like the expiration of the $7,500 federal EV tax credit in the U.S. that definitely hasn't helped demand.
Okay, so a lot of headwinds in automotive. But is this hitting everyone? Is the whole semiconductor industry feeling this, or is Onsemi kind of out on its own here?
That's a key question. And if we connect this to the bigger picture, the broader semiconductor sector is actually holding up surprisingly well.
Really?
Yeah. Take Texas Instruments, TXN. On the very same Monday on Semi tanked, TXN gained almost 1.92%. In fact, the overall semiconductor industry index had a positive day, up 2.34%. That actually outperformed the S&P 500, which was up 1.19%.
Okay, so there's a real divergence happening.
Exactly. Onsemi's plunge really highlights the pricing pressure in what you might call more commoditized areas like some of the power solutions. It's a stark contrast to the growth we're seeing in, say, high-margin chips for AI.
Right, the AI boom driving parts of the sector.
Precisely. So Onsemi's pain seems more tied to its specific market mix, especially that heavy automotive exposure facing economic headwinds right now.
It's good context that the whole sector isn't melting down.
Yeah.
But it does put Onsemi's specific challenges into sharper focus. Okay, despite these near-term problems, what are their strengths? Where are they placing their bets for the long haul?
They've made a really big strategic bet on silicon carbide technology, SiNet for short.
Silicon carbide. Okay, I know that's important for EVs.
Absolutely critical. Think of SiNet-I as this next-gen material that's way more efficient for handling high power compared to traditional silicon. Perfect for EVs, but also for massive data centers. Their Elite's product line is aimed squarely at EV traction inverters, basically the powertrain's brain.
Elite 6, got it.
And they're getting traction. They have a collaboration with Schaeffler, a big auto supplier, integrating these Seni chips, these MOSFETs. Some analysts even think Onsemi could capture half the new EV models in China by 2025 because of moves like this.
Half. That's ambitious.
It is. And beyond EVs, they're also working with NVIDIA.
NVIDIA. Okay, for AI.
Exactly. Developing 800-volt power systems for AI data centers. These need to be incredibly energy efficient, and Seni helps deliver that. They also made a strategic acquisition, buying CD's JF Tech from Qorvo. They see that as having like $1.3 billion market potential over 5 years.
Okay, so they're investing heavily in this CZ future.
Definitely. And remember that stat I mentioned earlier? Their CC business grew fourfold in 2023. So the strategy seems to be gaining momentum even with the current headwinds.
A fourfold increase is impressive. That points to a strong long-term direction, betting on EVs and AI. But how do they stack up against competitors right now in this tough market? And crucially, how financially stable are they, given the revenue dips and these big CZ investments?
Well, the competition is definitely fierce. You've got giants like Infineon, ST Microelectronics.
The big European players.
Exactly. They have larger overall revenue scale than Onsemi, but they're also dealing with their own issues, like market saturation in some areas. Onsemi's potential edge, though, is its vertical integration.
Meaning they control more of the production process.
Yeah, especially with CC. They control it from the raw silicon carbide wafers right through to the finished modules. That gives them potentially better control over supply chains and quality.
That sounds like a significant advantage, especially when supply chains have been so messy.
It can be. Now, financially, despite the current hits, they look pretty resilient on paper. They have about $2.69 billion in cash reserves.
Okay, a decent cushion.
And they generated $1.21 billion in free cash flow in 2024. Plus, they're investing heavily in R&D, over $612 million last year, about 8.65% of revenue focused on CC and power modules.
So they're still funding the future.
Yes. And they're also returning cash to shareholders. They bought back $654 million of their own stock in 2024.
Okay, so financially sound, investing in the future, but facing tough competition and market headwinds. It brings us back to the stock itself.
Yeah.
After this huge drop, what does it all mean for someone looking at ON stock right now? What are the technicals and the valuation telling us?
Okay, technically speaking, the stock is now trading very near its 52-week low, which is $31.04. Remember, it closed around $48 today.
Right.
And it's well below its 200-day moving average, which sits up at $54.12. The 52-week high, for context, was way up at $78.61.
So definitely beaten down. What about momentum indicators?
Well, the relative strength index, the RSI, is at 43.46. Generally below 30 is considered oversold, so it's getting close. It suggests the selling might be overdone, like a stretched rubber band potentially ready to snap back.
Okay, so maybe potential for a bounce.
Potentially. However, the MACD indicator, that's the moving average convergence divergence, which looks at trend momentum. It's showing bearish signs.
Oh,
Yeah, there's what's called bearish divergence and also a MACD death cross. That's usually a signal suggesting more downward pressure could be coming in the short term.
so conflicting signals from the charts. Oversold, but with bearish trend indicators.
Exactly. It paints a picture of volatility. Now, valuation.
Yeah, what about the price relative to earnings?
The PE ratio is currently up there at 40.74 times earnings.
40 times. That sounds high.
It is quite elevated. Compare that to the overall S&P 500 market average PE, which is around 20x, and direct competitors like Infineon are around 18x, ST Microelectronics about 16x.
So investors are still pricing in a lot of future growth for Onsemi, even after this drop.
That's right. It reflects long-term optimism, but it also means there's less room for error if they don't execute perfectly. Interestingly, though, despite the technicals and valuation, the stock does have a Zacks rank #2, which is a buy rating, so some analysts are still positive. And there's one more quirky historical point. A backtest analysis found that when Onsemi beats earnings expectations, like they technically did this quarter,
Yeah.
the stock historically has an 80% chance of going up over the next 3 days and averages a 4.2% return over 30 days. That's based on data from 2022 to 2025.
Huh. So history suggests a potential short-term rebound after an earnings beat, even though today was obviously brutal.
It's a curious counterpoint, isn't it? Adds to the complexity.
It really sounds like there's this major tension, doesn't it, between the very real short-term pain and pressure the stock is under and this potentially bright long-term picture built on C, EVs, and AI. So wrapping this up, what does the road ahead realistically look like?
Well, the near-term risks are definitely still there. You've got the macroeconomic clouds, inflation, interest rates. You've got inventory issues still working through the auto supply chain, geopolitical stuff too, the U.S.-China tech tensions, raw material supply worries.
All those factors can keep weighing things down.
They absolutely can. But then you look longer term, and the opportunities are just massive. The global EV market growing at maybe 20% a year through 2030. AI data centers needing huge amounts of efficient power projected to use maybe 30% of global electricity by 2025.
30%, wow.
Yeah. Both of those are huge tailwinds for Onsemi Sync technology if they execute well. So what you have is what we call a high beta stock. It's likely to swing more dramatically than the market overall, but it might offer, asymmetric upside, bigger potential gains than losses for investors with a longer view, say 12 to 24 months out.
If certain things fall into place.
Exactly. If they keep executing on Xiaomi, if that automotive revenue stabilizes, if they really differentiate themselves in AI power solutions. For more conservative folks, though, maybe a wait-and-see approach makes sense. See what the Q3 results look like later this year.
Right, wait for more concrete signs of stabilization. This deep dive really underscores how complex investing in tech is today. It's the immediate numbers, yes, but also these huge economic shifts and the big strategic bets companies have to make. Onsemi is clearly at a fascinating, maybe pivotal moment.
It really is. Which leads to a final thought, perhaps. Considering Onsemi's heavy investments in these forward-looking technologies, C for EVs and AI, and that vertical integration advantage they have, what will it actually take for market sentiment to shift, to move past today's cautious customer behavior and really buy into that long-term story again?